Good morning, Bitcoin, and welcome to another edition of your Bitcoin Economic Calendar, where we cover the news you need to know for the upcoming week in Bitcoin. Today is Monday, October the 19th, and in today's episode, we're going to be talking about the IMF seeing the writing on the wall for some global currencies last week. The US Senate is voting on a $500 billion stimulus package this week, and what do US bank earnings tell us about the state of the US economy? If you don't yet have a Ledn account, check out ledn.io and see how you can start earning the best savings rates for your Bitcoin and USDC. And now onwards to our analysis. Starting with Bitcoin, as always, we see that all eyes last week were on US stimulus, and the markets had a bit of a muted week as they wait for the next vote in the Senate slated for this coming Wednesday. Bitcoin did bounce around higher and lower levels throughout the week, but it settled at $11,514, up $140 or 1.23% for the week. Amongst the noticeable news last week, we had that on Thursday, the director of the International Monetary Fund stated that the world economy is facing another Bretton Woods moment. This is very significant, and we'll be discussing this in our market trends section today. Separately, on Friday, we had that OKEx, one of the largest derivatives exchanges by volumes, had suspended withdrawals as one of its founders was allegedly cooperating with authorities on an investigation. There has still been no further updates, and the mixed news throughout the week and no real directional move from the equity markets resulted in somewhat of a flat week, despite Bitcoin maintaining very, very strong fundamentals, particularly on the mining side, and we'll be covering this today in our difficulty section. Moving on to the S&P 500, we see that worldwide markets continue to wait on next steps around the US stimulus. The S&P 500 closed up 0.19% last week after bouncing around as well throughout the week with uncertainty around the shape and timeline of the next stimulus. With a vote in the Senate scheduled for this Wednesday on a $500 billion bill, there are still some doubts on whether the current proposal will get passed, as both the Republican and Democrat parties are touting mega packages, respectively, that are way above the $500 billion proposed. The markets will move regardless of the outcome, and I want to spend a minute to talk about why stimulus is taking such an important role. Now, stimulus is front and center for good reason. There's a link to the article you see on the screen on the blog. Bank earnings last week show us that investors have little confidence in continued stimulus after this year, and they are expecting credit delinquencies to start mounting in 2021, likely peaking at the end of next year. I believe the banks are signaling that passing stimulus bills will be much harder after the election cycle, and that they are cautious about writing off the reserves for delinquencies that they have built up. They see people's spending patterns have gone back to normal, with a few discrepancies around the sectors, i.e. they're spending less on travel but more on retail. So they're worried that there is no reserve left to pay down the debts. The stimulus has been spent, the debts remain, and unemployment is still significantly above pre-COVID levels. So we'll have to see how the talk around stimulus continues to unfold. Moving over to gold, we see that it gave back 1.6% last week, closing at $1,898. It has been effectively flat for the month of October and is likely waiting for a decision around the stimulus to form a strong directional leg depending on the outcome. Some volatility is likely this Wednesday, given the vote stated for the US Senate on stimulus. Moving on to the Fdx Defy Index, we see that as we anticipated last week, the index had a really bad week, closing down 8.25% under continued pressure. This trend looks like it will continue until the market capitulates. Emotions are still running high after many in the DeFi community realized that professional trading groups that were hyping up projects in communities when the market was rising are the same groups taking short positions on the same coins on the way down. Between this and recent moves by US regulators, it is likely that many market participants continue trying to book profits before they vanish, and the index in general can very likely see new lows in the coming weeks, so something to pay attention to. So in today's market trends sections, we're going to be covering the statement put out by the IMF this last week. The International Monetary Fund Managing Director Kristalina Georgieva put out an impressive piece on Thursday stating that she believes that the world is facing a new Bretton Woods moment. For those of you who may not remember, the Bretton Woods Agreement was established in 1944 after World War II by the Allied countries. And the agreement promised that the participating countries' central banks would hold fixed exchange rates between their currencies and the US dollar. The US dollar was at the backbone of the schema, itself backed by gold at that time. We have since moved far away from that. Today, the US dollar is not backed by anything, and neither are the currencies in most other countries. This statement is of great significance. The IMF is ringing the alarms on behalf of emerging economies that are currently staring at a monetary precipice. I'll try to summarize it as this. In her piece, the director pointed out that major central banks have expanded their balance sheets by $7.5 trillion. Emphasis here on major central banks. When was the last time you read about a blockbuster stimulus deal in India, Iran, or Brazil? There haven't been any. Now on to the commercial or retail banks. We see from the US earnings reports this week that the only reason US banks are still strong is because of the aggressive stimulus that has allowed people to meet their obligations. Bank deposit levels are also strong, signaling some willingness to plan for potential harder times ahead. Countries that have not yet printed more inorganic cash to stimulate their economies, or as Ms. Georgieva puts it so elegantly, expanded their balance sheets, have their banks staring at default. People have lost their jobs, loans are not getting repaid, banks are not getting their money back. These retail banks are staring at collapse. So, either countries print to save their retail banks and cause hyperinflation, or they don't print and have their internal banking systems collapse, with it, the internal economic productive apparatus. Now, what is the IMF proposing? They are proposing an aggressive external debt restructuring and potentially forgiveness plan for indebted emerging economies. Doing so would strengthen their balance sheets enough so that they could print the necessary stimulus without causing hyperinflation. It will take a lot of political will to coordinate such a move, and one must consider that some of the countries that would be seeking help have other forms of sanctions, for example, Venezuela and Iran. With this move, the IMF is trying to stop the currency dominoes in emerging markets from falling, but that's like trying to stop gravity. While this proposal is creative, there are other ways of strengthening your sovereign balance sheet, like being fiscally responsible, investing in programs with a real return for your constituents, and buying Bitcoin, like some publicly traded companies have done recently. Every day that goes by, it looks more likely that a government will dip its toes in Bitcoin. Now, moving on to our difficulty commentary, we see that the hash rate bulls are back. We hit a new all-time high in difficulty this Friday, reaching 19.97 terahashes, up 3.6% from our last difficulty adjustment. And since then, miners haven't stopped adding hash power. We're already signaling a new all-time high with a considerable increase for the next adjustment, which is not for another 2 weeks. And the estimate is to adjust upwards to 20.52 terahashes, which represents a further 2.6% increase from where we are today. Now, miners are some of the longest term investors in Bitcoin, and their stakes are very high, so it takes conviction. The fact that they are investing so heavily now is a clear sign that many veterans in the space are still very optimistic about the future of Bitcoin. And lastly, we wrap up with what's ahead for the week. As we mentioned in our introduction, the market moving news this week will come out of the US as the Senate is voting on a new stimulus package scheduled for Wednesday. There is a good chance that the market rallies if the package gets passed and that it sells off if the package does not pass. Regardless of the outcome this week, banks and people in general are worried about the idea of finite stimulus when there is no real finality around the current COVID crisis or timeline to regain normality. Aside from the stimulus vote, we also get a slew of earnings coming this week out of the US. While the markets seem to be more worried about stimulus than actual corporate fundamentals, we do have some key market players reporting this week, like Netflix after the bell on Tuesday and American Express Friday before market open. As always, we'll share any relevant information throughout the week through our Twitter accounts at HODL and we'll also be on Data Dash tomorrow showcasing our B2X loans. So thanks everybody and have an excellent week and see you next one.